Thank you, Hans Werner, Helmut, and everyone else for coming. I'm deeply flattered and pleased to be able to be here today and to be here at an event that honors Richard Musgrave, who I knew only a very little bit. He had retired from Harvard just before I arrived as a graduate student, but he came back from time to time and was always incredibly kind and generous to me and interested in what I was doing, and not just I, but other students as well. He was obviously a fabulous economist. The University of Michigan, where I work, is very proud of the fact that he was a professor at Michigan for more than 10 years and did much of his groundbreaking work there. But he was also a real gentleman, and it's delightful to be at an event in his honor. I want to talk today about international taxation. In the time that I have been an economist, things have changed enormously in the international tax landscape. The world has changed, but also our understanding of the world has greatly changed. My wife likes to point something out to me. 25 years ago, 30 years ago, I was complaining that nobody was talking about international taxation. Now I complain that everyone is talking about international taxation. And the reason I'm complaining is that there's a lot of nonsense, that is being said about international taxation, but it's better than having the topic not discussed at all. We have a much better understanding of these issues now than we did when I started working on them back in the 1980s. And when I think back to the situation in the 1980s, there was virtually no literature at all in this subject, no modern literature, certainly, and virtually no empirical literature. When I think about it, it should have been easy to make important contributions at that point because there was nothing out there. But I can assure you, it did not feel easy at the time. It was a struggle for all of us to try to think of how to make progress in this area. Well, there are times when it's a fantasy that humans have if you could see the future. I feel like when I look around now, I am seeing the future. I'm seeing all of these terrific young economists, many of them at this conference, many of them in Europe, who are working in this area with so much sophistication, so much more than was true of the people 25 years ago. We just have much more knowledge than we ever did before. But with the more knowledge comes more questions, of course. And now we're able to formulate questions we could not have imagined back in those days. So the good news is we know a lot more than we used to. The challenge is that now there are more things we want to know than we ever did before. What do we now know that we once did not? Well, we know a lot of things. What we know is that taxation affects the volume and location of foreign investment. We know that there is we suspect that countries compete for economic activity and for tax base. And we worry that national tax systems may be compromised by these developments. What should we do with this knowledge and with these concerns? I'll have some thoughts about that toward the end. First, let's start with what we know. What we know is that taxation has an important effect on FDI, which is foreign direct investment. There's a huge body of literature that says that, and it comes in all different forms. But I would say the prevailing elasticity estimates are 2.5 or 3, meaning that a small change in tax rates is typically accompanied by a quite large change in the volume of foreign direct investment. So it's clear that from this evidence, from the statistical evidence that we have, that countries' tax systems really do have an impact on how much investment they receive. This is nowhere more evident than in considering the tax havens around the world. Tax havens are very low tax rate countries. This is my personal list of the tax havens. There's some controversy about countries that are on here, and I can assure you that the governments of some of these countries have contacted me to try to get their name taken off this list. These are beautiful locations, many of them, especially if you think low tax rates are beautiful, because that is what is characteristic of these places, and they try to attract investment. If we look at these 52 jurisdictions as a group, everything from Andorra to Vanuatu and all in between, then collectively they have less than 1% of the world's population, those places I put on the board. Their combined GDP is 2.3% of world GDP outside the United States, not counting the United States. So they are richer than the average country because they're less than 1% of the non-US world population, and they've got 2.3% of world GDP. But the foreign affiliates of US firms have 27% of their gross assets in those locations. Now, that's a little bit misleading, that number, because you have assets if you can investment in the Cayman Islands, and then from the Cayman Islands make an investment in Germany. And that would count as gross assets, but it's not necessarily very meaningful. But US firms have 6.5% of their property, plant, and equipment in these jurisdictions, and that is meaningful. They've got 6.1% of their foreign employee compensation there. There's more US activity in these places than their economic sizes would normally warrant. Normally, investment is drawn to GDP. There's no mystery about where investment and economic activity goes. It goes to big, rich places. But these places are getting more than they would normally get. With less than 1% of the world's population, only 2% of the world's GDP, they're getting 6% of the activity. And it's not a mystery why. It's because there are enormous tax advantages to be had by being in these places. Now, that's just one example of how we know that countries' tax rates are influencing the investment performance there. It is also the case that countries differ in how they tax companies that are resident in those countries. That home country taxes themselves can have an effect on patterns of investment. And in particular, the sharpest evidence that we have comes from looking at very specific tax provisions that countries sometimes enact that punish firms that undertake certain types of foreign investments. When the countries introduce these rules, you find in the data that these foreign activities that are suddenly subject to high rates of tax start to disappear. And again, it's not really a mystery how that happens. That there is variation in the world in how countries tax the foreign operations of their resident companies is itself interesting. This is a table that covers the tax rules in place in 2010. I don't expect you to be able to read all of the entries on it. These are OECD countries, so it's the 34 richest countries. These 26 largely exempt foreign income from taxation. These 8 subject foreign income of their resident companies to tax. And the only major capital exporter among these 8 is the United States. Most of the OECD capital exporting countries are among the 26 that don't tax the foreign incomes of their resident companies. We can look at what happened with a couple of vignettes, and these are drawn from the United States. The first case I want to describe is in 1975, after the OPEC oil price increase, there was a lot of in the United States and in other countries, there was concern expressed about oil exporting countries and also about international shipping companies that carried oil from one place to another. And the US put on a limitation on deferral of the taxation of foreign income of US shipping companies. It was basically a tax, an additional tax on US shipping companies on their foreign income. It was introduced in 1975. In 1986, the United States added to that a provision that created separate baskets for the calculation of foreign tax credits for oil companies and for joint ventures, and actually a number of other type things. But certain foreign activities of US firms were subject to a much tougher tax regime starting in 1986. What we see is that for US shipping, this red line is the fraction of the world fleet of oil tankers that the United States represents, that US ownership represents. Prior to the introduction of the 1975 change, the United States had more than 25% of the world's fleet of oil tankers. The introduction of the tax penalty was here. It starts to decline. And then there was an additional tax put on here. And here is where the United States is now, which would be about 3% of the world's shipping fleet. There's more than one reason why US shipping declined as a fraction of the world, but taxation is certainly part of the reason. And I don't know if that was intended in 1975. I hadn't been born in 1975, so I wasn't around then. But actually, I had been born, but I just barely. Here's the picture for US joint venture activity. Again, in 1986, there was a tax change that put an extra tax penalty on American firms participating in international joint ventures, if they had less than 50% ownership of the joint venture. And what we see is, 1986 is here, by the way, is when the law took effect. And what you see is that the fractions dropped precipitously because deals that would have made sense suddenly did not. And because they no longer made sense, firms did not do them. Again, not really a mystery about how this happened, but there is a question about why you would want that to happen. I will say that many years later, the United States eventually repealed this rule, and US joint venture activity came back a little bit. But this is what happens when you have ill-considered tax provisions, which this was. There is a famous exchange between President Obama and Steve Jobs. I think most of you will know who Steve Jobs was. Steve Jobs is recently deceased. He was an extremely important guy. He was an entrepreneur. Many people revered him. Some feared him. And politicians knew they could not ignore him. He was the American equivalent of Hans Werner Sinn. And Steve Jobs had a conversation with President Obama that was widely reported back in 2011. President Obama asked him, what would it take for Apple, which was Steve Jobs' company, to make iPhones in the United States? And asked him, why can't those jobs come back to the United States? Because when Apple was founded, the manufacturing was originally done in the United States. Jobs famously replied, those jobs are not coming back, that they're never going to return to the United States. Most people interpret that conversation to mean that the wages are too high in the United States, and that's why the jobs are not coming back. The New York Times interpreted it to say, not that the wages are too high, that wouldn't be their interpretation, but that the flexibility, diligence, and industrial skills of foreign workers have so outpaced their American counterparts that made in the USA is no longer a viable option for most Apple products. The truth is, the reason those jobs left was international tax rules, actually, and that's for serious. What international tax rules? Well, Apple's intellectual property, which is the source of all of their profits, is widely believed to be held in low-tax foreign jurisdictions. How it got there, we'll get to that a little bit later. But under the US tax rules, if Apple were to manufacture iPhones in the United States, what would have to happen is that the manufacturing plant in the United States would pay a royalty to the Taiwanese or whatever country holds the intellectual property. Under US rules, that royalty would be subject to the Subpart F treatment, to CFC treatment. And it would be immediately taxable in the United States. In order for Apple to avoid being taxed on the value of its intellectual property, it has to manufacture outside the United States, given our rules. And that's why they manufacture outside the United States. It is also true that foreign are lower. But if you compare the cost of how much additional it would cost you to hire, an American worker as opposed to a Chinese worker, compare that to the tax advantage of manufacturing in China rather than the United States, the tax savings are much greater than the wage savings. I mean, both, of course, contribute to this. But, if Chinese wages rise, the iPhones will still be made in China or Vietnam or somewhere, but not the United States. And the reason is this sort of strange interplay of tax rules has produced that outcome. In fairness to the US tax system, the reason you had those rules was to try to prevent, in part, companies like Apple from having their intellectual property held outside the United States, because then you couldn't use it within the United States and still get the tax advantages. But that hasn't stopped the intellectual property from leaving. What it has done is prevented Apple and companies like it from manufacturing within the US, which is certainly not something people intended, but that is what has happened. There's various aspects of countries' tax systems that influence the financial flows of their companies. One of them is that countries that tax the foreign incomes of their resident companies typically defer taxation until the profits are returned to the country, the home country. And what that does is, in many circumstances, it gives taxpayers incentives not to bring the profits home right away, to wait for an advantageous moment to return them. Well, an advantageous moment arrived in the year 2005, because in 2004, the US changed its tax laws and for 1 year permitted 85% of the repatriated profits to be exempt from US tax. So if we look at a pattern of repatriations, this is what it looks like. This is every year from 1999 to 2007. Only certain profits were eligible for this exemption. They're the ones in red. But that's what happened. You went from about less than $50 billion a year of repatriations to $362 billion total was repatriated under this rule. Repatriated means brought back to the United States. You offered a temporary exemption, and this is what you get. Again, you can't really, it's hard to run a regression with just one event like this, but I think I can see that we know what happened and why we had all of these repatriations in 2005. There's one other aspect of home country taxation that comes up from time to time, and that is that if you have a punishing tax regime, it creates an incentive for firms to try to escape the tax regime by undergoing corporate inversion. In the business, it's often called a corporate inversion because the way you do it winds up turning the corporation upside down. It used to be that you had the home company and then you had a foreign subsidiary, but then once you become a foreign company, the foreigner is now the home and the domestic is now the foreign subsidiary. There is a new phrase for that. These are now, the trendy thing is to call them redomiciliation transactions. So you have to keep up, as I know from having a 15-year-old, but she doesn't know the phrase redomiciliation transactions, but you do now. So the redomiciling companies, and there have been a bunch of them recently, there's been waves of American companies fleeing the United States to get away from the challenging American tax regime, which is a lot tougher than many other countries. So now we have companies that are leaving for the United Kingdom, for Ireland, for the Netherlands, and there's some others as well. Many of them quite large firms. These transactions get politicians concerned. Part of the motivation that the United Kingdom had a few years ago to reform its taxation of companies was that British firms were leaving Britain for Ireland. And the United Kingdom, in response, has done many things, including adopting a territorial tax system, lowering its corporate tax rate, introducing patent boxes, and doing other things to try to make the United Kingdom a more attractive place. And indeed, the United Kingdom is now drawing American companies to re-domicile themselves to become British companies for tax purposes. Well, if you don't re-domicile, if you stay with your home country, how do you get to avoid taxes? Well, let's talk about how to avoid taxes, because you never know. You may need to know how to do this. There's an easy way to do it is to use debt rather than equity. It depends on the situation, but often it is the case that a corporation will have a tax advantage if it is financed with borrowing rather than with equity. And so this tax advantage is greater the higher is the tax rate. If you look across countries in the world, what you find is that even within the same companies, the affiliates that are located in higher tax countries tend to be financed with more debt, and the ones that are located in low tax countries have more equity. For data on American firms, there are three. You can put the foreign affiliates of American firms into three categories. On the far right, they're located in countries with 40% tax, 20% or lower tax rates. And in the middle, those are the middle tax rate countries. The vertical bars are two different measures of the indebtedness of these companies, debt to asset ratios. And what you see quite clearly is that the bars go up to the right. There's more use of debt in higher tax countries. It creates interest deductions, and that is beneficial from a tax standpoint. Now, how borrow, of course, is to borrow from yourself, because then there won't be any. The difficulty is that many countries' controlled foreign corporation rules make it difficult to borrow from yourself because the interest that you receive will be taxable. That's the challenge. If you take, for example, an American company that wants to do business in Japan, and Japan has for a long time had high tax rates, there's a real advantage to financing your investment in Japan with a lot of debt, because that generates interest payments from Japan, and that is a reduction of taxable income in Japan, and therefore saves you Japanese taxes. So you'd rather have expenses in Japan if you can, in order to reduce your Japanese tax payments. Here's the problem. When you receive the interest, if you make the loan from the United States, that interest income will be taxable in the United States, and we have a 35% tax rate, which is pretty high. So you're not going to save very much by putting a lot of debt into Japan if it is a loan from the United States. Much better to make it a loan from a low-tax country. So instead of investing in Japan if you're American, what you do is you invest in the British Virgin Islands, which has, by the way, 0 tax rate. From the British Virgin Islands, you make a loan to Japan. Your company in Japan pays interest back to the British Virgin Islands, where it is subject to tax, but of course the tax rate is 0, so that's fine. Here's the challenge. Under the US controlled foreign corporation rules, if you're not careful about this, that interest receipt in the British Virgin Islands will be taxable in the United States, and that would be a problem. So what you need to do is use the check-the-box entity classification rules, which have been available for about almost 20 years now, in order to arrange the affairs. A payment from Japan to the British Virgin Islands is not itself taxed by the United States. And it is possible to do things that way, and that is what American taxpayers do. It is a method of permitting you to get interest deductions and other expense deductions in high-tax foreign countries. There's nothing illegal about this. It's, in the US, not considered unethical, but it is a tax planning device, and companies use it. President Obama has proposed eliminating this, but he hasn't pushed very hard to eliminate it, because this is benefits American companies, by and large. Well, there are other ways to reduce your foreign tax payments beyond just borrowing and paying interest. Firms earn profits in a lot of foreign locations, but don't necessarily want to have to pay the taxes where they've earned the profits. Much better to get a deductible expense in a location where a high tax location, and have income appear somewhere else. There's controversy about how much of this goes on. We will talk about what some of the evidence says, but there's public discussion, and then there's controversy among the experts. The controversy among the experts is much less heated than is the public discussion. One of the recent cases was Starbucks in the United Kingdom. Here's the thing about Starbucks. Starbucks, by the way, for all of its glamour and everything, all they're selling is coffee. Okay, sorry? Well, there's difference of it. I won't repeat that because he did not use good language, but there's controversy about how good their coffee is. But I think we can all agree it's got a certain je ne sais quoi trendiness to it, and you pay extra because it's Starbucks, but really it's just a cup of coffee. Here's the thing, Starbucks has got the logo, they have the green outfits, they have their coffee shops look a certain way, and so you pay an extra €0.50 for your cappuccino, and it feels better because you're in Starbucks. Well, the issue is, where is the value created? Where should those profits from being Starbucks be taxed? Here was the issue in the United Kingdom. The United Kingdom has many Starbucks outfits. They were paying a royalty to Starbucks' Luxembourg affiliate, which held the trademark and other intellectual property for Starbucks, for the right to be Starbucks companies. Starbucks charges, I can't remember, it's 2 or 3% of the sales is charged as a royalty. In some countries, Starbucks owns the coffee shops. In other countries, they have franchisees who own like I could start a Starbucks in some countries, but you have to pay them 3% of whatever you take in. That's what you pay in order to be Starbucks. That's what they were paying out of the United Kingdom. The 3% mostly wiped out their profits in the United Kingdom. And so Starbucks paid more or less nothing in taxes to the United Kingdom because all their profits were really the return to the intellectual property, and the intellectual property was not held in the United Kingdom. It happened to be held in Luxembourg. How it got there, we can conjecture. But if it had been held in the United States, it would have been the same outcome, which is that there wouldn't have been any British tax left on the income because there was no net income to be had in Britain. This led to an outrage in the United Kingdom. Now, there were many reasons for that, but one of the consequences of the outrage is that we have now the base erosion and profit shifting initiative from the OECD and the G20. This is obviously not the only case, but this one kind of propelled the political machinery to do things about this. So what would be, Starbucks is perhaps a subtle example, even though that's the one that started all of this. What would be an extreme example? Consider a multinational firm with $5 million of income in Japan. Japan until recently had a 40% tax rate. If you earn $5 million in Japan, you have to pay a lot of tax. Well, the same firm perhaps has a foreign affiliate in the Bahamas, and they can buy a paperclip from the Bahamas and pay $1 million. You buy your paperclip, it's a strong paperclip. And you buy it, you pay $1 million, and what happens? It increases your Bahamas income by $1 million, but there's no tax, so it doesn't change anything. And it reduces your Japanese income by $1 million, and so obviously you pay a lot less Japanese tax as a result. This is clearly something that would be to the benefit of the taxpayer. Here's the thing. Japan and every other country has a rule that requires that the transactions used between related parties be conducted at arm's length prices for tax purposes. And an arm's length price is the price that unrelated parties would use for the same transaction, and they would not pay $1 million for a paperclip. So this transaction would not be allowed by the government of Japan. Here's the difficulty. We all know that a paperclip is worth a lot less than $1 million, or even less than $1. With intellectual property, it gets a little bit harder because it's more difficult to know exactly what it is worth, and that increases the opportunity for tax planning because taxpayers have an incentive to manipulate the prices used for transfers of intellectual property. to locate their intellectual property in low-tax jurisdictions. Intellectual property to a low-tax jurisdiction. One is you could develop it there in the first place. That does happen. It probably doesn't happen a lot, but it does happen. And there are, in Switzerland, in Ireland, research labs, and they have plenty of scientists in these places, and it's a great place if you can develop intellectual property, because then it won't be taxed very heavily when you get the returns to it. But there's a lot of intellectual property in places where they probably didn't develop it. It just was sold to those locations. That's a second way to get it there. You could develop the intellectual property in Germany or America and sell it to your Luxembourg affiliate. Trouble there is you're actually supposed to pay what it's worth. And when you do, that transaction will be taxable. And that kind of takes some of the fun out of this, because now you're going to have to pay tax on the way out. So a third alternative is to jointly develop the intellectual property, have the Luxembourg affiliate pay for the development, and then it gets to own the intellectual property tax on the transfer. The issue is, at what terms are these joint participations designed? And of course, they attempt to design them in a way to maximize the tax advantages to the taxpayer and thereby maximize the ownership of the low-tax affiliate in the property. What do we know about the use of intellectual property in base erosion and profit shifting? People believe that this is a very important aspect of how profits wind up located in low-tax places. I wish we had more evidence of this. We have very little in the way of systematic evidence. We have examples, and we have just tiny bits of statistical evidence, but not enough to really get a good sense of how much of this goes on, how big the numbers are. For that matter, even if you discover that a lot of intellectual property is held in low-tax places, it would be nice to know how much tax was paid in order to get it there on those transactions when it's being sold, say, from the United States to Luxembourg. When you read the newspaper stories of how outrageous it is that multinational firms hold property in low-tax locations, the story never tells you how much they had to pay to get it there, how much tax they paid in order to get it there. But there was, in many cases, there was tax being paid. We just don't know how much. Well, if we go more generally to how big is BEPS? How big is base erosion and profit shifting? The economics literature, we've been trying to estimate this for more than 20 years. And of course, it changes over time. But the basic idea is, what we believe is that firms intrinsically earn a certain amount of income somewhere. By the way, itself a complicated morass of issues and what it means intrinsically to earn income somewhere. And then attempt to shift profits, if possible, into low-tax locations. Well, how much happens? In order to know that, we have to know how much was actually earned in high-tax and low-tax locations in the first place. And of course, the data don't tell you how much was actually earned. You have to try to infer it. The quality of our estimates depend on the quality of our projections, the extent to which we're able to estimate how much would have been earned in the absence of tax shifting in different places, how much actually would have been reported in the absence of tax shifting. So, okay, what does the literature say? There were some kind of very large estimates of base erosion and profit shifting in the early days of the literature. Things have gotten better, more accurate over time. And over time, our estimates of the magnitude of this problem get smaller and smaller, interestingly. It's an interesting thing. The better we get at estimating it, the smaller the numbers seem to be. So the most recent estimates have semi-elasticities of 0.4, which are actually pretty small. So if you take a firm that is able to transfer income from an affiliate in a 25% tax rate jurisdiction to an affiliate in a 15% tax rate jurisdiction, at a 0.4 semi-elasticity, what that means of income in the high tax rate place, they report 9.6 million of income, which, to be sure, is less than 10. But it's not, staggeringly less than Our estimates are, from the evidence that we have, that the problem is fairly modest in scope. But if you go through the literature and look at older studies that frankly are less well done, including some of mine, by the way, you would see bigger numbers. But over time, the sort of better studies are getting smaller and smaller numbers. We see that actually from the tax havens. If you look at the data for US firms' operations in tax havens, remember they've got 6% of their business in tax havens. They account for 17% of the sales of American firms, 42% of their foreign income, and 11% of their foreign value added. People look at that 42% number, and it looks staggering. How could 42% of the foreign income of American firms be earned in these little islands, where they have hardly any employees? But the way that income is reported in these statistics, it includes if you have a tax affiliate that itself owns an operation in Italy, say, and the Italian operation pays taxes in Italy, then remits the profits through the tax haven affiliate back to the United States, it's counted as tax haven income in those statistics. But it's still taxed in Italy, and it's still taxed in the United States. So the 42% number, which is the basis of many calculations, I'm afraid, is really not the number to use. The number to use is the value-added number, which is quite a bit more modest. It's 11%. It appears that the tax havens, which are the lowest tax places and have 6% of American business, 6.5% of American firms report 11% of their income to have been earned there. There's no doubt that there's base erosion and profit shifting going on. There's more income reported in these places than probably was, a detached observer would think had been earned there. But it just accounts for 5% of the foreign income. The extra bit is not huge. It's big. It's significant. It's not zero, but it's not enough to turn your world upside down. And in particular, it's not enough to fund governments. Even if you got rid of all of that profit shifting, it's not going to generate very much tax revenue for the governments involved because the numbers are just too small. Base erosion and profit shifting, I'm afraid, is not the answer to all, even fighting it is not the answer to all of our problems. There are really three reasons. When you think about just the first order in the data, there are three reasons why we sort of know that base erosion and profit shifting cannot be that big a deal. The first reason is that countries continue to collect a lot of corporate tax revenue. If multinational firms could transfer their Germany would not collect much tax revenue, nor would the United States. They just wouldn't. But in the United States, 10% of the government tax revenue is coming from the corporate income tax. It's clear that corporations are not shifting all of their profits out of the United States. And as a result, they don't. Second piece of evidence. We said before that patterns of foreign direct true if base erosion and profit shifting were easy. If base erosion and profit shifting were easy, you would earn the profits wherever, you would do your investments wherever they can generate pre-tax income, and then shift all the profits to Ireland or Luxembourg or the Cayman Islands or somebody like that. And the local tax rates in these foreign countries would not affect where you did business because the tax rate would not become to you because you would just later shift all the income out. But we don't see that. What we see is the tax rates are consequential for where they do business, and that means they're not shifting all the profits out. The third piece is, and this involves some work I've been doing recently with Monica Schnitzer and Anna Gumpert here in Munich. Only very few, or a surprising number of multinational firms do not have any operations in tax havens. 80% of German multinational firms have no operations in foreign tax havens, according to the data that we have. 20% do, but 80% do not. If it was easy to shift your income out of Germany and into a low-tax jurisdiction, these other 80% of the firms would eventually catch on and maybe be interested in doing that. But they're not doing it. In the case of American firms, 60% of the very large US multinational firms, the ones with more than $250 million in assets and multiple foreign operations, only 60% have any tax haven affiliates. 40% do not. Again, it is telling us something. And what it's telling us is it is not that easy to move your profits around for tax purposes. Okay. What is in the national interests of countries to do in this setting? Look, we do have some base erosion and profit shifting. We certainly have taxes influencing where companies invest. What is in national interest? We have a theory that says it's inefficient to impose source-based taxes on businesses because the incidence of that tax ultimately on local fixed factors like labor and land, and it's more efficient to tax those factors directly. Is hurting yourself, imposing a more distortionary tax on yourself than you needed to otherwise. What's the evidence on this? Well, of course, it's hard to test. We do have evidence that countries with the lowest tax rates have fared very well during the era of globalization. If you look at the tax havens, they have experienced more rapid economic growth than high-tax parts of the world have. These data go through 1999. If you run it through 2000, just up to the crash, you get the same pattern, which is much more rapid growth of tax havens. The tax havens suffered during the crash of 2008, there's no doubt, because they were heavily in the financial industries, although many of them have bounced back since. But they accumulated so much growth over the preceding 25 years that they wound up, or 30 years, they wound up way ahead nonetheless. Then you might ask the question, given the success of the tax havens, why isn't every country a tax haven? And the answer is because I'm not in charge of every country. If I were, I might think that maybe they should think about trying to be a tax haven. There are many reasons why every country isn't a tax haven, and one of them is that there's domestic politics, and also not every country necessarily would benefit from having low tax rates. The reason low tax rates help you is if you can attract a lot of economic activity to sort of make it back to you for having the low tax rate. But you need other things in order to attract economic activity. A place like Germany would get more economic activity if it lowered its business tax rate, and same for the United States. But I don't know that there are many countries in the world that might not, because they're such bad places to do business, even a lower tax rate would not make them that much more attractive. If you look at the characteristics of tax havens in the world, there are three notable characteristics of the low tax rate countries. One is they tend to be small. Many are population. The second thing is they're more affluent than the average country. And that's partly because they're tax havens and they're getting the business that goes with being tax haven. And the third thing is they score extremely high, having to do with freedom of the press, democratic institutions, freedom of the judiciary. Where this is the log of their per capita GDP is on the horizontal axis, and their World Bank Governance Index is on the vertical axis, you'll notice that that is an upward slope. No surprise there. The rich countries have better governance, by the World Bank measures. And every dot is a country. The red squares are the tax havens. You will notice they lie above the regression line, almost all of them. The tax havens have better governance, even conditional on their GDPs. Again, you need to partial out the GDP because they're richer than average, and richer countries tend to have better governance. If you look just at countries that are small, that have less than 1 million in population, it's of course fewer data points, but again, we've got the tax havens lying above the line. What happens if you have a low tax rate and you have good governance? Hello, you get lots of investment. If you take the countries in the world and plot US foreign investment relative to their GDPs, There are 4 bars. On the far left are poorly governed low-tax countries, and the next one is poorly governed high-tax countries. By the way, poorly governed and high-tax, not so good for investment. But you can see that there isn't a big difference between these 2 bars. Where you get a lot of investment relative to GDP, and you are low tax. By the way, this is the cell you want to be in if you want foreign direct investment. And well-governed high-tax countries are this bar. It's really this, you have to be a fertile place for investment, and then also have low taxes, and now you're an attractive place and you get lots of investment, as this illustrates. Okay, what has been? Well, the answer to that would be yes, they have. There's controversy about why, and there's controversy about this measurement. It is not without controversy. We can compare tax rates, but of course that doesn't pick up other aspects that are important, like the definition of the tax base. But the tax rates nonetheless are telling you something. Really, by any comprehensive measure, business tax rates have in recent years come down among OECD countries. And that may be because of competitive pressures. It's hard to know exactly what role competitive pressures are playing and what role other things are playing. It's just hard to know. My guess is that countries do feel competitive pressures, some of them, but boy, it'd be nice to be able to show that econometrically, and the difficulty is it's hard. Here's what we do know, is that weighted average corporate tax rates have declined in the OECD. This is a chart for a US audience, and the point is to say that the United States, this is yet another example of American exceptionalism, rate high when everybody else's tax rate is going down. And there are, reasons to think maybe this isn't as modern a policy on the part of the United States as it might be. These are just, Rick asked whether these are effective rates, and no, these are just the baseline rate. It is true that when other countries have lowered their tax rate, they have tended to expand the tax base some, but it is also true, by most calculations, the expansion in the tax base is not enough to compensate for the reduction in the rate. Well, are low tax rates problematic? Only if you think they ought to be higher. If you do think they ought to be higher, yeah, they're problematic. If you think they should be lower, I suppose they'd be problematic in that they're not coming down fast enough. It really depends on what you think the right rate is. And by the way, the rate that we had 10 years ago is not necessarily the answer to that question. People tend to say, oh, look at our tax rates now relative to 30 years ago or something. But who said they were right 30 years ago? And who said the world, even if they were right 30 years ago, the world may have changed? Well, you want to get your tax policies and every other policy right if you can. So here we are. Should we worry about tax rates declining? Well, you can write down a model in which this is a problem. And people have written down these models, the Zodro-Miskowski. It's fairly contrived what you have to do in order to get a simple implication that too much competition among countries leads tax rates to be too low. It is also possible to write down a model where competition among countries makes tax rates too high. And it is like gold when you have a competitive situation. So the ability of us to write down a model where this is problematic does not help us very much. What we need to do is think hard about what policies you actually want. And there are arguments in favor. There are arguments in favor of having corporate taxes. But I will say our optimal tax framework is very uncomfortable with business-level taxes. I have never seen a thorough optimal tax model a la Murray. The world differs very much from our models. And even if our models tried to capture the world, governments wouldn't implement it, exactly as the model says. But justifications for why you want a corporate tax to begin with. It's been much easier for the political system arguments like corporations pay the tax, people don't, stuff like that. We could also ask, do we erosion and profit shifting? Sometimes in life there are things that you wish for, but then when you get them, you realize you shouldn't have wished for them in the first place. And I do wonder whether base erosion and profit shifting, at least to some degree, might not fall into this category. It's clearly a shame to leave some of these taxes don't pay the taxes that they really owe, unless other decisions of the taxpayers were actually predicated on their ability to get out of some of the taxes. You see, that high-tax countries are able to, some of the taxpayers know they won't have to pay the full tax. You take a country like France, for example, which has quite a high tax rate, nonetheless gets foreign investment. Part of the reason it's getting foreign investment is that some of the profits that were really earned in France are being reported in Luxembourg. And that's why companies are willing to invest in France. If we eradicated base erosion and profit shifting, and companies actually faced the 34% French tax rate in full, there would be less investment in France. And France might have to lower its tax rate in response. But when it lowered its tax rate, it would have to lower it on everyone, not just the multinational firms, because they have a uniform tax in France on businesses. So there are arguments that are out there that maybe permitting some taxpayers to get away with paying less tax, if those taxpayers have difficult to attract, and subjecting other taxpayers to higher rates of tax might not be a bad way for your tax system to operate. Now, sure, about that. France, you could imagine France fully enforcing its tax laws so that there's no base erosion and profit shifting. And national firms, because the American multinational firms will go to Canada or some other place if we try to tax them higher. It's not the kind of policy that tends to do well domestically. And that's part of the reason that countries don't do that. But they're kind of doing a version of that right now without being explicit about it. And that's themselves. Don't misunderstand. When firms, it is not as good to have taxpayers help themselves to tax reductions. It's better if you could make it explicit. But we have to be aware that if you solve one problem, you may be creating another for yourself. There are proposals and there are the very sensible having to do with tax administration and trying to coordinate what countries are doing, make it more sensible, make it more transparent to taxpayers, basically try to increase transparency and efficiency all around. And those are typically very sensible. There are much coarser proposals out there, such as to use formulary apportionment instead of arm's length pricing to divide corporate profits among jurisdictions. That is, instead of figuring out where each corporation earned its profits, just take the whole and somewhat ham-handedly allocate it based on where you have employees or where you earned profits. Most academics, have a tough time with these suggestions because they really don't correspond to who actually earned income. Or they're typically about as easy to manipulate as also proposals out to have strict harmonization of tax rates, sometimes within federations. There, too, the difficulty is we don't really have a theory of why every country should have the same tax rate. Indeed, the only theory I know of that says every country should have the same tax rate is the theory that the rates should be zero. There are theories that say all your business, Diamond Murley's says, I think that's what European Commission advocates have in mind. And the difficulty there is whatever is the optimal tax rate for Germany, it's probably different than the optimal. And say they have to have the same rate, then whose optimal tax rate do you choose? I will leave that to you. I'm pretty sure the United States will not join the coordination scheme. There are concerns called. The countries are worried about losing economic activity to other places. And there's this comes from an implicit assumption that if there's more economic activity somewhere else, that means there's less for me. In most economists, we don't think about the world that way. We think about the economy, there can be more business for everybody if conditions are right, because there are underutilized resources. And those underutilized resources can be drawn into providing more opportunity for everyone. Yet the political system tends to think in terms of it's a problem if there's more activity somewhere else. So if an American firm expands its operations in China, what happens to the US economy under those circumstances? Look, sometimes an American firm expands in China and they shut down their plant in Ohio in order to open one in China. And obviously, that costs American jobs. But the same company may, because they're operating in China, now be more productive and expand their operations in Tennessee or in New York. And the question is, which of these two is the dominant sort of force? Is it the substitution of foreign activity, or is it the kind of general productivity enhancement that foreign operations generate? Most of the econometric evidence suggests it is the latter. It is the productivity enhancement, that when companies expand abroad, they also tend to expand at home. And that sort of has to be true at some level. If countries were worried about offshoring, if the United States, there's discussion of offshoring, we could have a law. And the law says no American company can do business in, now you fill in the blank, Bangladesh, Vietnam, China, any foreign country. You could have a law that says that. Or you could have a law that says we'll tax it at 99%, which would be the same thing as prohibiting it. We don't have that law because it would be crazy to have that law. But why don't we have that law? Because we know that that's foolhardy. And the reason we know it's foolhardy is because companies would be so much less productive in today's world if they couldn't do business elsewhere in the world. So there is this concession implicitly that we know it's true that we all benefit from international commerce, even though our political rhetoric is often different, and even though we talk ourselves into some silly tax rules out of the thought that there is this substitution of foreign activity for domestic. Yet if you really thought that was true, then you should ban it all. But they don't, because they know it's not actually true. All right, this is my last slide. Where are we? The international mobility of economic activity and tax base does constrain governments in what they can do. It is a constraint on what you can do, and normally in economics, we think of a constraint as reducing welfare. And countries are better off if they have fewer constraints. That's what we normally say. But the reason we believe that is because we normally expect entities to act optimally. If you act optimally, you're better off with fewer constraints. That's true. Well, how should one think about the constraints that are imposed by international mobility of economic activity, or for that matter, any constraints policy, really any constraints. Think about the individual income tax. Suppose that there were no constraints, actually no constraints. The self-selection constraints, suppose they didn't exist. And how could they not exist? If the government had perfect information and perfect enforcement about everyone in the society, national, we do have a lot of information on people after all these days. Say there were no constraints at all on tax policy. Would that actually be better? Would it be better? We usually assume yes, because we assume that you would behave optimally. What do our models tell us would happen if you had no constraints on your tax policy? Oh, what the models say is clear. We would take from the rich and give to the poor. Indeed, we would take so much from the rich that they would be worse off than the poor. That's what the model says. Would that be a better world? Would that actually happen? Would it be a better world if there were no constraints? Here's the issue. The policies are determined in democratic institutions. And it may be that some democratic institutions are not ready for a world with no constraints. As it happens, we have constraints. With the individual income tax, certainly there's a constraint. And frankly, with business taxes, international mobility imposes constraints. And those constraints, limit what governments can do, and they know it. It may be, not through anyone's design, that we are actually better off by having these constraints than we would be without them. Because we may just not be ready yet for a world without them, given modern developments. I didn't know Richard Musgrave very well. I don't know that he would agree with me at the end about government being better with more constraints on it. But what I do know about Richard Musgrave is that he would relish in thinking about these issues. He was first and foremost an intellectual and I think a role model to us all. Thank you.